And we're a go. Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our March monthly research briefing, and a happy St. Patrick's Day to all who celebrate. CAPIS wants to thank each and every one of you for taking the time out of your busy trading day to spend just a little time with us. We hope that you find the following information in today's briefing useful. But as usual, before we get started, even today, the legalese. The opinion is expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation briefing are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any securities that might be mentioned. And now, of course, on with the call. But before I turn it over to Nick and Jessica, please note that they will take questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom, and I'll be sure to get to them and get them to them. Nick Colas is one of the two founders of DataTrek, a research consultancy focusing on market fundamentals designed to make the investment process more profitable, robust, and efficient. Colas is a 30-plus year veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity auto analyst at First Boston, now Credit Suisse. From 1999 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Colas was the director of research and chief market strategist for First Rochdale Securities and then Convergex Group. Jessica is also co-founder of DataTrek. She started her career on Wall Street as a research associate for a New York City brokerage firm when she was just 19. She was vice president of market strategy at Convergex Group prior to co-founding DataTrek. Jessica wrote economic and market commentary for the Morning Markets Briefing, a daily financial report widely followed by the investment community and media. She's also author of Alts Democratized, a practical guide to alternative mutual funds and ETFs for financial advisors, published in 2014 by Wiley Finance. Nick and Jessica, as always, welcome.
Oh, thanks very much, John, and thank you all for taking the time to listen in today. It's been a kind of wild ride in markets this year, so we will hopefully be able to make a little bit of sense of that for you and provide some context around it. We've got 5 topics today for the call. We've got the Russia-Ukraine crisis, obviously very important in terms of its effects on the global economy. We've got a discussion about oil prices and where is the tipping point for recession. Also, they're going to discuss Fed policy after yesterday's meeting. And then Jessica's going to cover what to expect from U.S. midterm elections and how do we interpret this year's stock market volatility in terms of future returns. I want to start my part of the conversation with a soundbite, which I think is very important and very telling about where we are in terms of the market today. And that's the following. Since 1990, the Fed has never raised rates or started raising rates when the VIX was over 22. So we're doing that right now, obviously. The Fed started a rate cycle yesterday with the VIX at 27. But why is that significant? It's significant to my view because, look, the VIX measures the market's near-term fear, near-term expectation of volatility. And the long-run average of the VIX back to 1990 when it started is 20. So 20 is the average. Come highs, come lows, the VIX average is 20. And the Fed typically has waited until economic growth was stable and predictable, and the stock market didn't express a lot of volatility on those topics before it started to raise rates. So, for example, 1994, first rate move in 94 after the 90 recession, the VIX was 15. In 1999, during that second liftoff of rates from after the Asia and Russia crises, the VIX was 21 when the Fed started to raise rates. In 2004, it was 14. In 2015, it was 19. So the average of the last 4 rate cycles, which is all of them on the upside for the Fed since 1990, is a 17 VIX on liftoff day. And again, we were at 27 yesterday. So we are much more volatile in terms of equities than the Fed has typically seen or ever seen in a rate cycle back to 1990. And that to me really crystallizes what's so unique about 2022. We have a range of events going on between oil prices, Russia, Ukraine, high inflation, and other things. What was going on with Chinese stocks, for example, and the Chinese economy earlier this year. And yet the Fed is still raising rates during a time when the stock market is expressing considerable uncertainty about the future economic outlook, which is very atypical for Fed policy, but here we are because of that inflationary pressure that Chair Powell talked about yesterday. So that to me is like the overarching way to express how unusual the current investment environment is, that we have a raft of uncertainties that are materially affecting stock prices, and the Fed is still going forward with rate hikes. So let's move off into our topics for the day. First one, Russia, Ukraine. You know, we read obviously a ton of geopolitical analysis, as all of you do, and you can express a huge range of outcomes on what might happen in Russia, Ukraine. A lot of them are negative, and a lot of them are much worse than negative. However, I will say this, the bottom line on all of those very nasty scenarios is the market doesn't believe any of them are going to happen, any of them. And that's a very simple way to explain that is the S&P trades at 4,400 or 19 times earnings. There's simply no way the S&P would trade for 19 times earnings if any of those very dire outcomes were to come to pass. So as much as it's a human tragedy and really heartbreaking to watch, just understand that the market doesn't expect it to be a kind of cataclysmic World War III kind of event, at least not yet. The market is saying it's absolutely going to be a problem, but it is not an existential problem. So I'm going to bypass the more dire things that people say about Russia, Ukraine, and just focus on two issues, two risks that I think are important and are present in the market today. The first one is we clearly face a real risk, and I think almost an assured outcome in terms of a European recession this year. Energy prices there have spiked, energy availability has spiked, consumer sentiment is coming down, and it seems very likely we are going to have a recession in Europe this year. Germany was already going into a recession because of lack of chips for automotive production at the end of last year. And the rest of the European economy likely faces a recession in the call it the second and third quarter of this year because of high energy prices and because of lower consumer sentiment and because of worries about the financial system. So I think a European recession is, first of all, you can tell from European stocks it was getting priced in already, but I think it's very much a lock. You're going to see a European recession this year. The second issue, and this is more global, is a protracted supply chain problem around the world, primarily in metals and basic foodstuffs, grains, which Ukraine obviously makes a ton of. That means we're going to see higher inflation for longer around the world. And the market understands this and accepts it and is pricing it into inflation expectations, but you still have the reality of that going on around the world. So it has made the inflation fighting a lot more difficult for central banks. It's going to be a little bit easier in Europe because their economy never was as strong as ours after the pandemic, and now it's beginning to roll over, but it's still going to be hard on the US because we do have a lot of inflation here aside from food, but it's going to feed the foodstuffs and general inflation cycle. So the summary point on Russia-Ukraine is that it's very easy to make Russia-Ukraine a very scary topic. And we understand why it concerns people, and we understand why the images are horrific and why it's upsetting. But at the same time, the market is saying this is a very addressable problem. It's not going to cause a huge world war. It's not going to create anything more systematic. At the moment, the market is reading it that way. And as long as the market reads it that way, I think we're on safe ground. Now, the thing I'll tell you is we look a lot at market volatility, as Jessica will discuss, and it will be concerning if we start to see volatility pick up again. And what we always tell clients is you want to look at the VIX, and the VIX at 36, 44, or 52, because that is multiple standard deviations away from the mean. The mean is 20, as I mentioned. 8 is standard deviation. So 36 is 2 sigmas, 44 is 3 sigmas, 52 is 4 sigmas. And you want to be buyers of stocks when it hits those levels, because those are the levels where on a 1-year return basis, you have a 90+% chance of making money. So if we do get a reversal in Russia, Ukraine, and things begin to really go south, and the VIX spikes to 44 or 52, those are good places to buy. But I wouldn't look at the market before then. And we are overall cautious on stocks. even with stocks holding in fairly well. So let's turn over to topic number 2, oil prices and tipping points for recessions. Our view, and this comes from, as John mentioned, I covered the auto industry for a long time in the 90s. And I learned from the economists that work for the big three that it's not so much the given price of oil that affects consumer confidence and spending, it's the change. It's how quickly oil prices spike. And basically their old rule of thumb was that a 90% to 100% 1-year change in the price of oil, WTI, is what creates a recession. And I've had that in the back of my mind ever since, and I still use it to this day. So 90% change year over year is a magic number for causing a recession. So if you go back to 1990, during the first Gulf War, oil prices spiked by 96% year over year. In 2000, people forget, but commodities had a super cycle and oil was up as much as 140% year over year in 2000. We would have had a recession even without .com blowing up because oil prices had spiked so far so fast. And in 2008, we had a similar situation. Oil prices were up 96% year over year. Again, people forget that because the financial crisis came along, but in those 3 prior instances of deep recessions, we had oil prices spiking. That is as much a creator of recession as anything else. So the current tipping point for oil based on a year ago prices is $124 a barrel. That is the level where if you saw oil prices go to that level and stay there, you could be relatively assured of getting a recession. Now, interestingly, WTI got right to 124 on March 8th and then backed off. So I don't know if the market understands there's just demand destruction that happens at those levels, or it was just coincidence, but 124 is a level to watch. If you get back up to those levels and stay there, history says you're going to have a recession. That's the level we look for. And we'd get a lot more cautious on stocks if we got to 124, 125 in the near future and stayed there. Now, my last topic, topic number 3, Fed rate policy, and what we heard from Chair Powell yesterday. You know, the Fed guidance, and I think why the market really liked the Fed guidance was very reassuring. Fed said 25 basis points every meeting for the rest of the year. Nice, steady cadence. And Powell was pretty, I'd say, clear that that was his preferred path. Now, if you look at the dot plots, though, you'll see that there's a good chance that you could see at least a 150 basis point increase because the split on the dots is pretty even around that tightening cycle of 25 a meeting. And Fed funds futures this morning, I just checked the prices before I got on this call, say there is a very good chance of a 50 basis point increase by June, 80% odds right now that the Fed goes 50 at either the May or the June meetings. The good news is that Fed funds futures also say that the first half is when we're going to see the 50s. If we get them, it's first half. Back half of the year, all 25s. So for the moment, we're kind of stuck twixt and tween 25 and 50. Fed funds futures say definitely 50 at May or June. I tend to agree. And I think that's sort of the next conversation the market has to have, equity markets have to have with the rate market about whether or not 50 is too far, too fast. 50s have not had a great history in this in the market. For those of you like me who are trading back in 94, you'll recall that 94 was a horrible year in many parts of the year, very volatile and not much return because the Fed was doing surprise 50 basis point increases. And it's a tough environment when you get that way. Now, the issue we're watching very closely is the spread between 2 and 10-year bonds, because that tells you the 2-year side tells you what the market expects for Fed policy, and the 10-year side tells you what the market thinks is the neutral rate of interest. And when expected Fed policy gets above the neutral rate, that's when you typically have a recession. So if you look at a 210 spread chart back for 3 or 4 decades, you'll see it very reliably predicts recession. If you get that inversion, a year later, there's usually a recession, because the Fed has overstepped and created a situation where Fed funds are too high relative to the neutral rate and the economy slows down. The spread between 2s and 10s right now is 23 basis points. So getting very close to zero, because the market so far is not really pricing 10 years consistent with inflation. What's very odd is that the Fed's talked about tapering and done it, and it's talked about running off the balance sheet. It's going to start doing that probably the next meeting, and yet 10 years are nowhere near neutral. They're nowhere near where a real rate would be zero. That'd be closer to 3% nominal, because we're still dealing with negative 1.5% real rates. So the bond market so far totally kind of blown off the Fed as far as the potential impact of running off the balance sheet on long-term rates. And that's why the 2-10 spread is so narrow. So what we're looking for and what we think is super important is to see 10-year yields continue to climb, showing that the bond market is taking the Fed seriously and the Fed is able to affect the longer end of the curve and slow down the economy. That's critical because if the 10-year yield doesn't move, then the Fed is going to be forced to use the monetary policy from the short end of the curve much more aggressively. So it's our hope that rates get to 2.5 and then 3, because that'll limit the amount of times the Fed has to raise interest rates at the short end of the curve. We'll see how that goes. So far, it's not great. Equities tend to like low 10-year yields, so it's going to hurt the equity market in the near term. But in the longer run, it's a much more sustainable market setup. And so that's why we're looking for it to happen. So the summary here is 10-year yield should begin to rise. That's what we're watching for. And we'll see what inflation numbers look like in the next couple of months, because I think that's going to tip the Fed's hand and push them into doing 50 basis points at the May or June meeting. But after that, we should have an easier path to go with Fed funds. So with that, I'll turn it over to Jessica, who's going to discuss market volatility and midterm elections.
Thank you, Nick. As Nick for stock market volatility trends, and then the upcoming midterm elections this November. So first, given that the S&P 500 has had a difficult start to the year, I'm going to outline what history says we can expect for US equities during the balance of 2022. Now, to baseline this discussion, the average total annual return for the S&P is 11.8% back to 1928. Currently, the S&P is down 8.5% year to date as of yet. It's down 8.5% year to date. We are at least up from the current low for the year on March 8th, when the S&P was down at 12.5% year to date. But now the important question is, have we already seen the low for the year? And on that question, we have 3 points. Number one is that the S&P recorded one of its 5 worst performances since 1980 for the month of January this year, which is a cautionary signal, as January is typically indicative of rest of year returns. When the S&P is down in January, which only happens 40% of the time, it tends to produce a lower annual return compared to when it is positive for the first month of the year. The difference here is an average annual return of 3.6% versus 15.5%. So it is a widespread, and even if you exclude the worst performing year of 2008, the average annual return for years when January was negative is just 6.2%. So the takeaway to this first point is that history shows down Januaries on average correlate to subpar returns for the rest of a given year. Our second point is that when the S&P has produced a negative total annual return over the last 60 years, it has bottomed in the back half of the year all but one time. For example, the S&P has been down on a total return basis in a fifth of years over the last 6 decades. During those 13 years, the index bottomed in June once, September twice, and November twice, but it bottomed the most in October and December at 4 times each. So the takeaway to the second point is that the S&P has not bottomed until at least June, when it has finished the year in negative territory on a total return basis. So if you are bearish on US equities this year, know that in prior years when it's been down, it's troughed the most in Q4, or 3/4 of the time. Our last and third point is that if the S&P generates a negative total return this year, and its current low of 12.5% marks the bottom, that would prove shallow relative to history. In the 13 years the S&P has had a negative total annual return, it was down an average of 23.3% through the low of each year. So the bottom line to these 3 points is that if the S&P finishes the year in negative territory, history says US equities haven't yet bottomed, both in terms of scale and timing. Now that's if investors think the S&P will be down this year. But what if you think US large caps will be able to squeeze out a gain in 2022? So we looked at what happens during years when the S&P has produced a modest positive total return over the last 6 decades, or when the S&P has been up between 0 and 5%. We have 3 quick points here. The first is that it is actually unusual for the S&P to only post a positive return of less than 5%. It's happened in just 6 years over the last 6 decades. Our second point is that during these mediocre positive years, the S&P has only bottomed for the year between Q2 and Q4. In other words, if the S&P is able to finish 2022 in slightly positive territory or up less than 5%, history says it won't likely bottom until at least Q2. Our third point is that there's a wide range of outcomes in terms of how deep the S&P falls to its low for the year during years when it posts a small gain overall. So far in 2022, as I said, the S&P has fallen 12.5% for the year's lows earlier this month. That's slightly worse than the average of down 11.9% for the 6 years with gains of 0 to 5%. But as shown in our point number 2, the annual low does not usually come until at least April, rather than in Q1 as we are now. So to wrap up my first topic, even if you think the S&P can squeeze out a modest gain in 2022, there's still likely more pain to come, given that the annual low doesn't come until at least Q2 during these types of years. And if you don't think there's any way the S&P can register even a small gain this year, history says to be very cautious here, as when the S&P is down for the year on a total return basis, it almost always troughs in the back half of the year, and mostly in Q4. My last and final thought on this is that we're not trying to say that the S&P will be down this year. As Nick said, we are cautious here, but that's why this framework's important, because should that outcome seem more likely as the year progresses, and the more the S&P loses time to recover, investors will need to continue navigating the same issues that got the S&P off to such a bad start to this year, namely the Fed's monetary policy decisions for the rest of 2022, and now also the Russia-Ukraine conflict for the foreseeable future, and how both impact economic growth and U.S. corporate earnings will leave an overhang of uncertainty that could further dampen investor confidence, keep volatility elevated, and potentially push off the bottom for U.S. large caps till later in the year. Now let's move on to my second topic. The 2022 midterm elections are now just 236 days away. So as much as we at DataTrek try to be as apolitical as possible, I'm going to outline the current outlook for the midterms, as this is going to be an increasingly important issue. As of now, Democrats control both chambers of Congress and the White House, but every seat in the House will be up for grabs this coming November. The challenge for Democrats is that the president's party usually experiences a net loss of House seats during midterms, and they do not currently have much of a cushion. Democrats only hold just an 11-member advantage, and there are 2 Republican vacancies. Now, when it comes to House elections, the size of the loss is a very strong correlation with presidential approval ratings. So here's a brief summary of the post-World War II presidential approval data and election results from Gallup. In 5 midterm elections since World War II, the sitting president has had an approval rating of 60% or higher, and their party lost an average of just 3 House seats in the midterms. In the other 14 midterm elections since World War II, however, the sitting president had an approval rating of less than 60%, and their party lost an average of 34 seats in the midterms. Now, President Biden's latest Gallup approval rating is just 41%, and that's below the average of 59% for elected presidents' 5th quarter in office. And the closest historical analogs in terms of midterm results are Reagan in 82 at a 42% approval rating and a loss of 28 House seats, Truman in 1950 at a 39% approval rating and a loss of 29 seats, or lastly, George W. Bush in 2006 at a 38% approval rating and a loss of 30 seats. And I'll just quickly note that since World War II, there's only been 2 presidents that have seen their party gain seats in a midterm election, and both had approval ratings of over 60%. That was Bill Clinton in 1998 amid a strong economy, and George W. Bush in 2002, which was geopolitical related after 9/11. Clinton is a good example of how the state of the U.S. economy is a key driver of presidential approval ratings. So the bottom line here is that with such a thin House majority, Democrats know President Biden will need to make up a lot of grounds in terms of his approval rating in order to have a chance at holding on to congressional control. Now that's the historical data, but in terms of tracking the likelihood of which party will keep or gain control of both the House and Senate this fall in real time, we like to use a site called predictit.org. This website allows users to place small money wagers on lots of political outcomes, such as which party will win control of the House and Senate after the midterms. We've used PredictIt for many years and find that it tends to be more accurate than polls, given that users are actually putting money on the table. And of course, there's no contracts directly tied to political probabilities in traditional capital markets. And before I get into the data, I'll just preface it by saying, while there could be some partisanship in the odds, that's why we look at the overall probability trends rather than just their current levels. Now onto the data. There's two PredictIt contracts related to the midterms that we follow. The first is which party will win the House in the 2022 midterm election. Republicans currently have 85% odds, which has remained steady over the last 90 days. Democrats have just 17% odds, down slightly from 19% over that time frame. Of course, a lot can happen between now and November 8th, but again, Democrats only hold 11 more seats than Republicans, and we know from the Gallup data that presidential approval ratings of lower than 60%, like Biden currently has, lose an average of 34 House seats. The second contract is which party will control the Senate after the 2022 election. Republicans currently have 77% odds, up from 71% 90 days ago, and Democrats have 26% odds, down from 31%. So PredictIt users have grown more confident that the GOP will also win control of the Senate over the last 3 months. So to wrap up my second topic, and as for why all this matters, it means that Republicans have solid chances of taking back both the House and Senate, which will mean there will likely be political gridlock during the second half of President Biden's first term. So with that, we'd be happy to take any questions.
Thank you, Jessica and Nick. Appreciate the commentary. I have one right here. I think this is going to you, Nick, and it has to do with measuring inflation. What indicators are you looking at in particular? Is it just the price of oil? Do you watch core CPI or some other subcomponent?
Yeah, we look at a bunch. In terms of the standard data, the CPI is the thing we tend to focus on the most, but we break it down into subcomponents, particularly food and particularly proteins within food, which is fish, meat, poultry, eggs. There's an explicit CPI category for that, because food inflation is how consumers really perceive inflation. And when food inflation is high, they perceive overall inflation as high, and they tend to not have their expectations be fairly well anchored, which is the Fed speak for what they want to see. So we look at CPI, we look at components of CPI. In terms of leading indicators of inflation, that's a tougher one. There's a New York Fed, and anybody who's interested can find this on the website. The New York Fed has a supply chain monitor index they just put together a few weeks ago and have started publishing regularly. And so the supply chain issues still look very bad. They're 3 standard deviations away from the pre-pandemic mean. So we look at that as an indicator of kind of supply chain issues as they affect inflation. The last thing I'll say, and this we just did for clients last night, if any of you use Google Trends, very easy to use, and it allows you to track the number of times people search for a given word. We use Google Trends to track searches in the US for the word cheap, discount, and coupon. So things that people would search for in Google, like a coupon code for a store, or a cheap gas, cheap airfare, cheap home insurance. I mean, those are all fairly common searches. And the funny thing is, so far, the number of searches that include cheap, discount, coupon are down over the last 5 years. They're down now versus pre-pandemic, which is extremely odd given that inflation is such a hot topic among consumers right now. But the issue is they have enough money to pay for the things they want in the aggregate. There's still more employment, there's still wage hikes. And so we look at the counter to the inflation situation as well, not just what the inflation numbers say, which they're very high, obviously, but how consumers are responding. And thus far, because the economy is so strong, consumers are not responding the way I thought they would. And they're not searching for cheap items. We'll see when that changes. I literally wrote this up last night because we've been waiting for this to turn for 2 months. We usually write about it like once a month, and it hasn't happened yet. So we'll see when it happens. But until consumers begin to recognize inflation and their shopping behaviors, I'm not sure we're going to see a peak in inflation itself.
All right, Nick, thank you. Jessica, I have one for you. Someone sent me via email here. Is there any chance that the Democrats can keep control of the Senate or the House for that matter, or stem their what's being termed as severe loss, projected losses?
That'll be very difficult. Like I just said, with the House, the current sitting president usually loses seats. So, and an average, like I said, of 34% or 34 seats, unless he's able to get above a 60% approval rating, which is going to be very difficult with inflation so high. And obviously, the Fed is walking a very fine line between trying to bring down inflation without tipping the economy into a recession. But like I said earlier, economic growth is a key determinant of presidential approval ratings, but they'll have to make up a lot of ground very quickly. So it'll be a tough battle.
Thank you for that answer. And I don't see any other questions in the queue other than those two. So with that, I'd like to conclude our monthly research briefing. It's been terrific having both you, Nick, and Jessica back, your first time in 2022. We're so excited to have you back on board this year. Our next research briefing is going to be on April 21st. And that's going to feature market policy partners. So we ask everyone to please stay tuned for that. And also check out part 3 of our ongoing series on outsourced trading. Why now and why one size does not fit all. It's available on our website, www.capis.com, and on our LinkedIn feed. On behalf of the CAPIS family and DataTrek, we want to thank you all for watching and ask that you have a great trading day. Bye-bye.